The moving average convergence divergence, MACD, is a widely utilized technical indicator that assists traders in identifying potential buy and sell signals by analyzing the relationship between two moving averages of a security's price. It comprises the MACD line, the signal line, and the histogram. The MACD line is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The signal line is the 9-period EMA of the MACD line, and the histogram represents the difference between the MACD line and the signal line. Traders often interpret crossovers between the MACD line and the signal line as potential entry or exit points. A bullish crossover occurs when the MACD line crosses above the signal line, suggesting upward momentum, while a bearish crossover occurs when the MACD line crosses below the signal line, indicating downward momentum. Additionally, the histogram provides insights into the strength of the trend. Increasing histogram bars suggest strengthening momentum, while decreasing bars indicate weakening momentum. 1. Trend identification. Before executing trades based solely on MACD signals, it's crucial to assess the prevailing market trend. Utilizing a longer-term moving average, such as the 200-period EMA, can help determine the overall market direction. In an uptrend characterized by prices above the 200 EMA, traders may focus on long positions, seeking buy signals from MACD crossovers. Conversely, in a downtrend, with prices below the 200 EMA, short positions may be more appropriate, entering trades upon bearish MACD crossovers. This approach aligns trading decisions with the broader market trend, potentially enhancing the probability of successful trades. 2. Entry signals. Once the market trend is established, traders can look for MACD crossovers as potential entry points. A bullish crossover, where the MACD line crosses above the signal line, may indicate a buying opportunity, especially when it occurs above the zero line, suggesting strong upward momentum. Conversely, a bearish crossover, where the MACD line crosses below the signal line, could signal a selling opportunity, particularly when it occurs below the zero line, indicating strong downward momentum. It's important to consider the context of these crossovers. For instance, a bullish crossover during an uptrend may carry more weight than one occurring during a downtrend. 3. Divergence analysis. Divergence between the MACD and price action can provide early warnings of potential trend reversals. A bullish divergence occurs when the price forms lower lows while the MACD forms higher lows, suggesting that the downward momentum is weakening and a reversal to the upside may be imminent. Conversely, a bearish divergence happens when the price forms higher highs while the MACD forms lower highs, indicating that the upward momentum is weakening and a reversal to the downside could be forthcoming. Identifying such divergences can offer traders opportunities to enter trades ahead of significant price movements. 4. Exit strategies. Determining when to exit a trade is as important as identifying entry points. Traders can use several methods to establish exit strategies. One approach is to monitor the MACD for crossovers in the opposite direction. For instance, exiting a long position when the MACD line crosses below the signal line. Another method involves setting predefined profit targets and stop-loss levels based on risk tolerance and market conditions. For example, setting a stop-loss at a certain percentage below the entry price and a take-profit level at a multiple of the risk can help manage risk and lock in profits. It's essential to adapt exit strategies to individual trading styles and market dynamics. 5. Risk management. Effective risk management is vital to long-term trading success. Traders should determine their risk tolerance before entering a trade and adjust position sizes accordingly. A common rule is to risk only a small percentage of the trading capital on each trade, often between 1% and 2%. This approach helps mitigate the impact of potential losses and preserves capital for future trades. Additionally, using stop-loss orders can limit potential losses by automatically closing a position when the price reaches a predetermined level. Combining these risk management techniques with MACD signals can create a robust trading strategy. 6. Combining with other indicators. While the MACD is a powerful tool, combining it with other indicators can enhance its effectiveness. For instance, the Relative Strength Index (RSI) can help identify overbought or oversold conditions, providing additional context to MACD signals. If the MACD indicates a bullish crossover and the RSI is below 30, suggesting oversold conditions, the buy signal may be more reliable. Similarly, using chart patterns such as support and resistance levels can provide further confirmation of trade setups. Integrating multiple indicators helps filter out false signals and improves the robustness of trading strategies. 7. Timeframe considerations. The effectiveness of MACD signals can vary across different timeframes. For short-term traders such as day traders, using shorter periods for the EMAs like 5 and 13 can provide quicker signals, although they may be more prone to false positives. Swing traders might prefer the standard 12 and 26 periods, balancing responsiveness with reliability. Long-term investors may opt for longer periods, such as 21 and 50, to capture more significant trends. It's essential to align the MACD settings with the chosen trading timeframe and strategy. 8. Backtesting and optimization. Before applying any MACD-based strategy in live markets, it's prudent to backtest it using historical data. Backtesting involves applying the strategy to past market data to evaluate its performance and identify potential weaknesses. Traders can adjust parameters, such as the lengths of the EMAs and the signal line, to optimize the strategy for specific market conditions. While backtesting can provide valuable insights, it's important to remember that past performance does not guarantee future results. 9. Psychological discipline. Maintaining psychological discipline is crucial when trading with the MACD or any other indicator. It's easy to become emotionally attached to a trade, but decisions should be based on objective analysis rather than emotions. Sticking to the predefined entry and exit rules, adhering to risk management practices, and avoiding impulsive decisions can help traders stay on track and improve their chances of success. 10. Continuous learning and adaptation. The financial markets are dynamic, and strategies that work well in one market condition may not perform as effectively in another. Traders should continuously evaluate their strategies, stay informed about market developments, and be open to adapting their approaches. Engaging in ongoing education, such as reading trading books, attending webinars, and participating in trading communities, can provide valuable insights and help traders refine their strategies over time. By incorporating these elements into a comprehensive MACD trading strategy, traders can enhance their decision-making process, manage risk effectively, and improve their chances of success in the markets.